So before looking at columns of numbers to validate the banking strategy, it's first important to understand it from a conceptual standpoint. And this little story I call the buyer's dilemma, I think best describes it. It's really simple, and it starts with the even line down there at the bottom in black, where you have no savings or no debt. And all that's fine and good right up until you need to make a purchase in life. So all of us need to buy cars, homes, business equipment, inventory. And in order to do so, you either need to use your own money that you've saved up, or you need to pay for the use of somebody else's money through financing. And let's look at the first one, taking on debt and paying it off. So you can see that red line that extends down below the even line represents you making that purchase using somebody else's money, and the stair steps heading up to the right represent you making systematic principal and interest payments to get back to even. And once you've paid off that debt, inevitably another purchase needs to be made, hence another line going down and more servicing principal and interest payments to bring you back to even. And so the story goes. Now if we move on to what it's like to pay cash, what we can see is that before you can even make the purchase, you first need to save up money into an account, often earning little or no interest, in order to pay cash for that purchase. Now, even though you don't need to pay principal and interest to an outside institution for the use of their money, if you do want to pay cash for the next round of that purchase, whenever that is, you do need to make principal payments back to that account, earning very little or no interest in order to pay cash in the future. Now, it is worth noting that even though you're on the right side of the even line, you're not really making any progress with this pool of assets. And it's because you're constantly consuming it for purchases along the way, which kills any sort of compounding you get. And this is where the banking strategy comes into play. You see, in a perfect world, you'd save up assets one time and they'd go ahead and compound into the future. And what's so powerful about compounding is you not only earn interest on your principal, but pretty soon you earn interest on the interest your principal's already earned. And so it creates this wonderful snowballing effect. That's why the curve on the right is a lot steeper than on the left. In fact, when I ask clients, which side of this curve would you rather have, everybody wants the side on the right. But it doesn't exactly work like that. You see, it's just time value of money. Keeping assets continually compounding over time is the key. Unfortunately, though, these purchases do need to be made, and every time they are, it just resets our compound curve to the very beginning, killing our chances of ever getting to that far right-hand side of the curve. That is, unless there was a way to contractually borrow against our assets at any time for any reason. And you can see when we do, that red line comes down, indicating there's a lien against our asset base, but notice that the entire asset base continues to compound up that green curve. And as we pay down the lien against the assets, we actually end up at a higher place in line each and every time. And that's really the biggest component of this whole strategy. The fact that your entire asset base continues to compound in your favor, in spite of having used some of it to make those purchases. Now, it helps too that the asset class we've chosen also happens to grow each and every year at a very favorable rate of return, one that does not start with a dot, and it's immune to market losses and immune from taxes as well. All these things work in its favor. Now keep in mind the cash flow structure that we're using, the payment structures, we're going to compare apples to apples with somebody paying cash. And the fact that you don't have your entire asset base compounding for you when you withdraw cash from an account to make a purchase, you'd need such an astronomical rate of return to make this work and to overcome any taxes due that it simply just pales in comparison to how effective the banking strategy can be.